Hi, and welcome to Corporate Bond ETFs, the latest installment in the IndexUniverse webinar series. I'm Allison Jones, Director of Conferences at IndexUniverse, and I'll be your host for today's webinar. I'm pleased to be joined on the call today by 4 experts on corporate bond ETFs. From our own shop, we have Matt Hougan, our President of ETF Analytics, and Gene Koisman, one of our ETF analysts. Also joining us today are Gopi Vangalara and Jason Bloom. Gopi is a financial advisor with Orion Financial Group, while Jason is Vice President at Guggenheim Partners, a leading provider of ETFs, including corporate bond ETFs. Corporate bonds are one of the fastest growing areas of the ETF market, and our goal in today's webinar is to provide a comprehensive overview of the space, discussing both why advisors might move into corporate bond ETFs and how they might go about doing so with ETFs. The format today is very straightforward. Matt and Gene will kick things off with a 25-minute presentation covering the case for using corporate bonds and for evaluating corporate bond ETFs. Then we'll bring in Gopi for a brief presentation on how he thinks about corporate bond investing and ETFs. Finally, we'll bring in Jason for a moderated Q&A at the end. And after that, we'll open it up to the audience for additional Q&A. And we're sure there'll be lots of exciting ground to cover, so there'll be lots of Q&A. As a participant in the webinar, you can enter questions at any time during the webinar using the Q&A box located at the bottom right-hand side of your webinar screen. Like I mentioned, please don't wait until the end to ask questions. Submit them as they occur to you. We collate the questions on our end throughout the webinar and answer as many as we can at the end. With that, I'd like to hand it over to Matt Hougan. Matt?
Thanks, Allison. I'm hugely excited about this webinar, I have to say. I think it's coming at an extraordinarily timely moment in the market. Corporate bonds in general and corporate bond ETFs in particular have just been riding this huge wave of popularity. I mean, corporate bond ETFs pulled in about $7 billion in net new money in 2011, and they've started 2012 by pulling in $5.6 billion more in less than 2 months. Just one ETF, HYG, has attracted $2.8 billion this year, making it the 3rd most popular ETF of 2012 so far. Investors are clearly looking at the shaky economy on one hand and throwing out stocks, and zero interest rate treasuries on the other and throwing out treasuries. That doesn't leave much to invest in, so they often end up right where you see that money flow, in corporate bonds. But the coup de grace for me for this sort of corporate bond renaissance, and the reason we have Jack Bogle's picture up on the webinar right now, is I was doing an interview with Jack a couple weeks ago for the Journal of Indexes. You can read that interview in its entirety on our website, IndexUniverse.com, after this webinar. But I'll give you a teaser. In the opening questions, Bogle, the founder of the Index Mutual Fund and probably the most straight-laced index investor in the world, told me that he wouldn't buy the Barclays aggregate right now, that it's too concentrated in government securities, which are yielding nothing, and that he would significantly overweight corporates. But my jaw just about dropped and hit the floor. Bogle overweighting corporates. But one major trend we're seeing in the advisor space is advisors taking a more tactical approach to owning bonds. With sovereign risk roiling the markets and treasuries yielding nothing, it's easy to see why. So if all you index investors out there have been tempted to get more tactical or more strategic in the corporate bond space and have felt sort of the need for benediction, just know that you have it now, at least for the time being, from Bogle himself. But if you're going to get more tactical, the question is, how do you do it and when do you do it? To answer that question, Gene and I want to take a step back and talk about how to frame your analysis of the bond space. And really, I think that means thinking about the primary sources of risk and return in bonds. Bonds, of course, function effectively as IOUs. You loan money to an institution, be it a government, a corporation, etc., for a set period of time, and in exchange they pay you a fixed amount of interest. For the purpose of argument, let's imagine you loan a company $1 million for 10 years, and they agree to pay you 5% a year. This is really a closed transaction. In the equity market, your upside is theoretically infinite. When you buy a stock, you're hoping the company dreams up a new iPad, cures cancer, and goes on to generate trillions of dollars in earnings. You're paying, in effect, for an eternal stream of what you hope are rising dividends. But with a bond, your returns are capped. The single best thing that can happen to you as a bond investor is that you get your money back plus a little. You loan that $1 million, you get 50 grand a year in interest payments, and at the end of 10 years, you get your $1 million back. That's it. No upside, no runaway returns. And because a bond deal is a closed transaction with a fixed upside, there's a hard and direct relationship between price and return. Setting aside credit risk for a minute, the return you get on a bond is mathematically fixed. Let's imagine that you buy that bond paying a 5% yield at par. In other words, you buy $1 million of bonds for $1 million with the promise of those $50,000 a year annual payments. Now imagine 1 year later that interest rates have fallen and the same company is issuing debt at 2.5% interest. Suddenly your 5% yield looks mighty attractive. It's twice as high as market rates. In theory, somebody should be willing to pay more than par value for your bonds to get hold of that extra yield. How much more? Well, it depends on the term of your bond, but whatever the specifics are, the price of your bond has to go up to keep it fairly priced compared to newly issued bonds. This relationship, the seesaw between the price of a given bond and its yield compared to the universe of similar bonds, is the key driver of bond returns. Of course, that relationship is rarely as simple as just looking at price versus yield. Here at IndexUniverse, we like to think of the bond space like a 6-layer nacho dip with varying layers of risk and potential return. The link between price and yield, which we discussed earlier, is that nice little bit of cheese and chives at the top. That's the place where treasury investors play. There is no default risk, at least that's what we're led to believe, so all you're left with is price and yield. With corporate bonds, though, you're digging a bit deeper into the tomatoes, the guacamole, the bean dip, or rather credit risk, liquidity risk, and other concerns. It can pay off with a tasty bite, but you also run the risk of biting off more than you can chew. Really, from our perspective, the nacho dip looks like this. We should credit this visual to Mr. Terry Benshawal, who delivered it to us for use at our Inside ETFs conference. Broadly, the risks that borrowers take divide into two: interest rate risks and credit risks. The first part affect every type of bond, while the second part, at least until recently, only impacted corporates. Interest rate risk, of course, compensates investors for changes in rates. Investors demand higher rates, generally, to lock in interest income for a long period of time. Credit risk addresses the likelihood that the borrower will not pay back borrowed money. Many investors think of this as a binary risk. I either get my money back or I don't, but it's actually much more nuanced, asking questions like, how much money will I recover if there's a default? How variable is that default risk? And how quickly can I exit a bond if the risk starts to dial up? Gina and I will walk through these risks, which will, I think, provide a nice framework for evaluating how to approach strategically managing your bond portfolio.
So let's dig into that nacho dip, Matt. The foundation of any bond investment is the interest rate, and the foundation of all interest rates is the federal funds rate. As we all know, this is effectively zero right now on the short side, and the Fed has stated that it expects short-term rates to remain near zero through 2014. This, combined with investor expectations for long-term inflation and long-term interest rates, creates the current Treasury yield curve. Any movement in this curve has a huge impact on bond investors. If rates rise, prices fall, and investors caught holding bonds will be hurt. This is one of the big concerns right now. Treasury yields have been declining with a few hiccups since September 1981. When that trend reverses, bond investors will get hurt. On the flip side, if interest rates fall, well, interest rates can't really fall much right now, but if they did, returns would be strong. Importantly, this curve can change in different ways. For instance, imagine that the yield curve for treasuries looks like this. It's actually much lower right now and not quite so normal looking, but this could be considered of a kind of long-term version of what the yield curve looks like on an average. But the curve can shift quickly. When interest rates rise across the board, we call it a parallel shift in the yield curve. In this case, while investors will receive yields higher than previously earned, you'll see a market reduction in the value of the bonds. Remember that lock system Matt talked about earlier. This is the major source of downside risk for bond investors short of default. Alternatively, we see interest rates twist from time to time. This is what the Fed was trying to accomplish a while back with Operation Twist, when it shifted the Treasury holdings from short to long-term interest rates. Its goal was to drive down long-term interest rates, a task at which it was somewhat successful. In this scenario, some bond investors benefit. After all, if long-term rates come down, the value of those bonds should go up, while others could suffer. You can also get kinks in the yield curve. When short-term supply-demand dynamics throw a certain part of the yield curve out of whack, these typically represent temporary mispricings, which are corrected and smoothed out over time. Understanding the yield curve and predicting its movements is one of the keys to successfully and tactical bond allocation. How should investors think about this? In our Nacho dip, we highlighted real rates and inflation expectations because those are the key predictors of the shape of and the structure of the curve. Remember, when you loan money to someone, you get the same par value back at the end of the term. If inflation has eaten away into the real value of the sum, you need to be compensated with higher income along the way. Rising inflation expectations should drive rising rates, which will impact pricing. Investors who think the market is underestimating future inflation will want to stay on the short end of the curve, which shouldn't react so much to long-term changes in interest rates. Investors who think that inflation expectations are overblown will be willing to move further out on the curve. But in general, it comes down to this. Investors who are willing to lock in a rate for a longer period of time are taking more interest rate risk. If I loan you money for 30 years at 5% and inflation spikes to 15%, I'm getting crushed. You can move further out on the curve to earn more income, but you're taking on more inflation risk when you do.
And of course, interest rate risk is only part of the equation, one of the top layers. The other extremely important layer, and the one that drives people to invest in corporate bonds, is credit risk. On the one hand, we have treasuries, which are as close to risk-free in terms of default as you can get. And at the far other end of the spectrum, we have tiny, small-cap companies on the verge of bankruptcy issuing bonds to support their cash flow. Obviously, people will want a much higher return if they're loaning money to the shady small-cap company, and that's where we get the idea of spreads. The credit spread is the difference in rates that investors demand to compensate them for this credit risk. Typically, this is measured by comparing credit bond spreads to treasury spreads. When people talk about spreads widening, they mean that investors are demanding higher yields to compensate them for taking on credit risk. When people say that spreads are tightening, they are looking for less compensation for that risk. Tightening spreads generally are good for corporate bondholders. Widening spreads, not so much. As you can see in this slide, spreads have tightened substantially since peaking during the financial crisis in 08-09, pulling in from nearly 6% to 2.5%, a nice ride for corporate bond investors. That's not an all-time low, but it means much of the easy money was made during that spread collapse. Yields for corporates came down, and prices went up. At the heart of the credit spread really is a basic concept, which I mentioned earlier, that investors should be compensated for defaults in bonds by earning extra income. In theory, that added interest rate and those payments should cover default losses with a little bit of extra income to compensate you for the added risk. So how should you as an investor think about and evaluate credit risk? Well, there are a number of ways, the commonest which is credit ratings. Ratings agencies provide investors with their opinion on the likelihood of default by rating bonds from AAA, highest quality, to D, or guaranteed default. One important thing to note about credit ratings, and one we'll mention time and again, is that the relationship between credit ratings and default rates is not linear, but exponential. For example, this is in this slide, we're showing sort of the average 5-year default rates for different credit buckets. And if you look at the difference between AAA rated and AA plus rated bonds, the difference in default is 0.05%, which means an additional 1 out of every 2,000 bonds will default over the next 5 years based on historical estimates. But the difference between BBB minus and BB plus is a 4.2% increase in default. In other words, for every 2,000 bonds, an additional 84 will default. From B to B minus, it's more like 100 additional bonds, and it expands further from there. That's why statistics like average credit ratings, which are used widely by ETF issuers and by many ETF analytics systems, are misleading. The chart on the right graphically demonstrates the default probabilities from the previous slide. So let's imagine you had a portfolio that had one bond in each agency rating. You want to find the average credit rating of this portfolio. Most systems do it like this. They take the AAA bond, count that as 1. The AA plus bond, count that as 2. The AA bond, and count that as 3. And then they add up all those numbers and take an average. And if you did this for this portfolio, you'd find an average credit rating of BB plus, or one notch below investment grade. And you would be very, very wrong. Instead, look at the columns that show the historical default rates over a 5-year period for each rating. Rerun your average, this time using those historical default levels, and you'll come to a number around 20%. That maps to a B plus average rating, 3 notches below the simple method used in most places. To the extent that people rely on credit ratings, they need to look past the average credit rating and drill down on a more granular level to look at default risk. Doing this can give you the context if you're being appropriately compensated for taking on that risk.
Since not everyone is a fan of credit ratings, another way is to look at default risk. Another way to look at default risk is to look at what the market is telling you and measure the level of compensation the markets are pricing into the bonds. This is done by calculating the extra yield required above treasuries to determine the discount factor that would result in the current price. In other words, the amount of the spread that should compensate you for the expected default. The most robust of these plugs is a value known as an option-adjusted spread, which measures the all-inclusive spread above treasuries. Many models for evaluating and forecasting credit risk exist as well. These include fundamental, statistical, and structural approaches, or a combination of the three. Fundamental approaches evaluate credit from a bottom-up, looking at the ability of the borrower to repay the debt. Statistical models evaluate the likelihood of default based on historical or market data. Structural models use equity option price volatility to determine the probability of default. Entire courses are dedicated to evaluating each of these approaches. The key takeaway is credit analysis is complex and very difficult to forecast, even for rating agencies. And oftentimes, the credit rating and the credit spread don't always agree. While the initial evaluation of credit rating agencies can be quite accurate, they do a poor job of monitoring the changes in credits of the issuers. This leads to changes in ratings of bonds lagging the spreads in those bonds themselves. I love this chart, which shows with a violent clarity that spreads anticipate rating changes and not the other way around. From about a year out for downgrades and as much as 3 years out for upgrades. You can see the price anticipate credit agency changes. One interesting note is that the interest payment for downgrades often overreact in the months that follow the downgrade.
So why do investors take on this hard-to-evaluate credit risk? Well, it's all about balancing where you source risk to get a certain yield. So consider what happened last year. Yields dropped across all maturities. Long-term treasury bonds in particular saw a major rally. Investors looking at the middle part of the treasury curve today, say looking at 5-year treasuries, are looking at a yield of less than 1%. With inflation expectations running above 2%, you're effectively guaranteeing yourself that you'll lose money. You know, woohoo. How do you react? Well, you have to think about that nacho dip. You really have two choices. You can either move further out the curve, taking on more interest rate risk, or you can move further out the credit continuum, taking on more credit risk, or you can do some combination of both. So right now, investors can earn an extra 2.3% of yield by being in investment-grade corporates instead of treasuries at the 5-year mark. If they're willing to go out to junk bonds, they get an extra 6.3% of yield. Framed another way, an investor has to move to the 9 or 10-year point on the treasury curve to receive the same yield as a 5-year AA corporate. And getting junk bond yields in the treasury space, forget about it. You just can't do it. So you have to ask yourself, would you rather take on the risk of interest rates rising and inflation surging, or would you rather take on the credit risk that comes with either investment grade or high yield debt? That's the core question strategic bond investors need to ask themselves. Interest rate risk, credit risk, or both? Either way, you need to balance out those two levers to create a given yield outcome to meet your needs. And of course, with corporate balance sheets in an all-time strong position, many investors are indeed choosing corporates. I note, of course, that we're not even going to touch the hot button issue of whether or not Treasury bonds are truly default-free. We could spend 5 hours on that, and we'll save that for another webinar. A few notes before we move from the concepts of corporate bonds to the ETF choices investors have and how to pick the right ETF to meet your needs. The first things we want to make sure we point out is that corporate and investment grade and junk bonds are big buckets. Before we dig into how to use ETFs to get specific exposures, it's important to understand that credit spreads vary drastically across these rating levels and within these buckets. Generally speaking, the greater the credit spread in the bond, the greater the credit risk in the bond, the higher the spread and the higher the volatility of that spread. The chart here illustrates the option-adjusted spreads for the Barclays Capital Credit Index as a whole and its subparts broken down by credit rating. And you can see how just moving higher and higher in the spreads, volatility rises dramatically, say just from AAA to AA alone. ETF providers increasingly allow investors to more specifically target different credit levels, so this kind of differentiation within, say, the investment grade bucket is going to be increasingly important. ETF providers also now allow investors to tap into specific sectors of the corporate bond market. The first corporate bond sector ETFs launched recently, and you can see here that spreads vary significantly between sectors at different portions of the curve. Right now, financials tend to carry more credit risk than more stable sectors like utilities, and this is reflected in average spreads. Obviously, your own take on the outlook for these sectors determines your view on where these credit spreads and credit risks and interest levels will be. And if the risk of these sectors improve, if, for instance, financials recover and stabilize, yields will come in and prices will improve. Regardless, the key takeaway is that there is a great deal of variety in credit risk, and investors looking for extra yield have many options to choose from.
So let's talk about how you do it, how you actually gain access to the bond space. The first choice, investing in individual bonds themselves, we'll dismiss here. It is a major challenge to buy individual bonds in the U.S., and doing so abroad is even hairier. You can do it, but if you're comfortable doing that, you don't need me to tell you how. The solution most people arrive at is a package solution, and here you have three basic choices: ETFs, mutual funds, and closed-end funds. Closed-end funds have historically been a popular way to access difficult areas of the market like high-yield debt. Closed-end funds like ETFs trade on an exchange, allowing you some measure of liquidity. They tend, however, to have relatively high costs. Moreover, they can and do trade at extreme premiums and discounts to fair market value. Because you cannot arbitrage away that premium or discount, there is no telling when that premium or discount trend will end, or if it will widen, shrink, or disappear over time. Investors who want to control premium and discount risk can use mutual funds, which allow you to buy and sell exactly at net asset value. Mutual funds have two drawbacks. However, first, you can only trade once a day after the close of trading, so you're limited in your responsiveness to market moving events. More importantly, however, costs are high. The average corporate investment grade bond mutual fund, according to Lipper, charges over 1% in annual fees, with 12b1s and other load charges stacked on top of that. They also have an additional cost in the form of trading costs, which we'll get into later. By contrast, the most popular corporate bond ETFs charge around 50 basis points in annual fees, have no loads and no 12b1 fees, and externalize some of the trading costs that hurt bond funds' returns. ETFs have certain other advantages and disadvantages too. They offer intraday liquidity on the upside, but can trade at significant premiums and discounts in difficult market conditions. Before we dig into these challenges, however, let's first review what's available to you as an ETF investor in the bond space. Within the ETF space, there are currently 41 different corporate bond ETFs available, and that number is growing rapidly. Predominantly, these are focused on fixed coupon U.S. investment grade and junk bonds. Recently, however, issuers have launched funds focused on floating coupons, bank loans, and preferred stock investments, giving advisors new alternatives for how and when they plan to gain yield. This month, iShares took things a step further, launching the first ever ETFs that chop the U.S. corporate market into various sectors, providing exposure to financials, industrials, and utilities. iShares also launched a new corporate bond ETF capturing just the super investment grade credit ratings from AAA to single A. Traditionally, investment grade bonds ETF have driven down into the BBB minus space. Geographically, however, it's more homogeneous. Basically, it's all U.S. While issuers have stocked the pipeline with corporate bond offerings in both U.S. dollars and local currency from developed and emerging markets, nearly all corporate bond ETFs out there right now are focused on the U.S. On a segment basis, however, it's more varied. Among the hundreds of bond ETFs in registration, more than 40% of the funds are focused specifically on corporate bonds. These include theme plays such as fallen angel bond funds in the U.S. and global markets, as well as thinner slices of the credit buckets and everything in between. The ability to navigate specific areas of the market has never been greater. Another major innovation in the ETF space, one that has funds available but also more funds in registration, has been pioneered by Guggenheim, which is the fixed maturity bond ETF. One of the challenges that investors have with bond ETFs is that they never mature. If the promise of a bond is that you get your money back at the end of the term, with ETFs that term never comes. Many investors like to buy bonds that mature at a specific time in the future, often a time when they will need the money, so that when they get the bonds, they get the cash. That way, the bonds get more and more conservative from a duration perspective as the need date approaches. It's a nice way to handle interest rate risk in a target date-like fashion. By contrast, the amount of money an investor will have from, say, a traditional investment-grade bond ETF is completely variable, as the fund will constantly replace bonds as they fall out of targeted maturity range. As a result, a fund's value at a future point is unknowable, subject to the same interest rate and credit risk issues we discussed earlier. Bullet shares funds from Guggenheim, as well as competing target maturity bond ETFs from State Street and other providers, solve this problem by holding bonds that mature at a specific date. At that date, the fund will wind down and give the money back to shareholders. These funds represent a fast-growing corner of the ETF market and present an important option for investors.
So if you do choose to use ETFs, how do you choose which one is right for you? Obviously, the first choice is which market you want to access. If you feel adventurous and want high-yield bond exposure, the new fund focusing on top investment-grade credits is not for you. But even if you do want high-yield bonds, there are 9 funds competing for investor dollars and more in registration, with more than $27 billion invested between them. So how do you choose? Well, let's take this one area and make it a test case and narrow down how to pick and choose among similar funds. As many of you know, we have a system we use here at IndexUniverse to evaluate ETFs, and fortunately it goes by an acronym that's easy to remember, ETF. But in this case, instead of standing for Exchange Traded Fund, we use ETF to mean efficiency, tradability, and fit. Or to put it another way, before you buy any ETF, ask yourself, can I trust it? That's efficiency. Can I trade it? That's tradability. And can I do better? That's fit. The first place to start is with our ECS tool, which can help you narrow down what options are available. If you look in the fixed income asset class at corporate bond ETFs for high yield, you'll see 11 choices. You have the Advisor Shares ETF offering active exposure to the corporate space, the PIMCO fund focusing on short-term corporates, a Power Shares fund that's fundamentally indexed, leverage and inverse options from ProShares, Guggenheim's Bullet Shares offering exposure to 2013, 2014, and 2015 bonds, and you have the big generalists, HYG and JNK, from iShares and Spiders, respectively. Now, if you want a fund with a specific year, say 2014, you only have one choice and you're done. But what if you want that broad-based, market cap-weighted exposure to the corporate bond space, and you're left with those two choices, JNK and HYG? Now, both funds are hugely popular with $11 billion and $13 billion invested in them, respectively. So how do you choose? Well, you drill down into the E, T, and F analysis. Now, by now, the basic contours of our efficiency analysis are known to most of you. When we say efficiency, we mean, does this fund deliver on its core promise to investors with low costs and no untoward risks? If this is an S&P 500 fund, does it deliver the returns of the S&P 500 accurately and with no hidden risks? As you can see from this chart, J&K costs less than HYG with a 10 basis point cheaper expense ratio. However, when you look at the actual performance of the two, HYG is the clear winner from a tracking standpoint. So one of the statistics we've pioneered in our analytics service is what we call the one-year tracking difference. This is a measure of how far a fund has deviated from its benchmark index on average on a rolling 12-month basis. And as you can see, HYG does extraordinarily well on this measure. Despite charging 50 basis points in fees, HYG has actually trailed its index on average by just 12 basis points, 38 bips better than its expense ratio. J&K, by contrast, has missed the mark by 89 bips, 49 bips worse than its expense ratio. How does this happen? Well, three primary factors account for the difference, all under the broad umbrella of management. First, there's the question of optimization. As with most bond funds, HYG and J&K do not necessarily fully replicate the indexes they aim to track. Regardless of that, the skill in following index changes and managing the fund for liquidity can have a real impact on returns. A lot of people assume that anyone can run an index fund, but it's very hard to get off good trades, especially when everyone else in the world wants to trade the exact same thing at the exact same time. The second part that impacts this is securities lending. Based on the most recent annual reports, HYG generated $2.9 million in securities lending revenue last year. J&K, by contrast, didn't engage in sec lending at all. And while this isn't much of a boost, it generated about 2 basis points per year for added performance for HYG, with, of course, some risk. Finally, and most importantly, the two funds differ in their creation mechanisms. HYG processes the bulk of its creations in kind, meaning APs must supply the firm with baskets of the bonds it wants to hold when they are creating shares of the ETF. By contrast, J&K processes many creations in cash, meaning firms submit cash and the fund must go into the market and buy bonds anytime it receives new investment. This has the salutary benefit of capping the likelihood of the fund to trade at a discount and making the ETF arbitrage process easier for APs. However, it raises the risk of slippage if the fund has to trade that money in the market. It's worth noting, by the way, that all mutual funds use cash creates effectively, so to the extent that this represents a drag on returns, it's one that exists for mutual funds as well as some ETFs.
We mentioned earlier that ETFs can experience significant premiums and discounts in the corporate bond space, as the liquidity of the underlying securities can have a real impact on the ability of the APs to arbitrage price differences. As you can see, the premiums and discounts of the two corporate bond ETFs, as measured against their end-of-day NAV, varied significantly over the past year. Whether this represents a mispricing of the NAV or a mispricing of the fund is an open question, but there is important information here. While both funds saw substantial premiums and discounts, J&K's were muted against those of HYG. This makes sense, as J&K's cash create facility should translate into tighter premiums and discounts over time. You'll see that the outlier events aren't that different, possibly because HYG has the flexibility to take in substantial portions of cash during crisis moments, capping the maximum discounts. But the average premium discount and the variability of the premium discount is dampened. Finally, you get to the tricky part, fit. By fit, we mean, does this fund give me the kind of exposure to the market that I'm looking for? In order to do this, we first define the market by selecting a broad-based benchmark against which to compare the fund in question. A relative comparison can then shed light on their differences. The challenge is to select a benchmark with the best combination of investability and representativeness. In this particular case, we compare the two funds to the Barclays Capital High Yield Index. The result that jumps out is the high beta of the benchmark for both of these funds. This suggests a lot more volatility in both funds relative to the broad high-yield market as a whole. The other item that shows up is a negative alpha for J&K. We believe that alpha, positive or negative, must be earned, and we test it for statistical significance to have confidence in its persistence. I happen to be a believer that past performance doesn't guarantee future results, but it's important to understand the past to have a sense of the future. So where does this high beta come from? A look at some key statistics and holdings data can help shed light on the situation. J&K has tilted towards lower quality bonds, which is reflected in its yield and credit bucket breakdown. The other key difference is the number of holdings. Having more holdings in the benchmark likely has reduces the concentration risk, which could contribute to the high beta if it's diversifying into less liquid securities. Still, the tilt toward lower credit quality is the key differentiator between the funds and is something worth keeping in mind. While this analysis can help better understand the mechanics of the fund and funds and their relationship to the broader market, it's important to keep in mind that fixed income is inherently opaque and data is hard to come by. Even getting information that lines up to the same dates can be a challenge.
So where should and what should investors do as they approach the corporate bond space? Well, first, they should look at how and why they're positioning themselves. As you search for yield, how far out the interest rate curve do you want to move? And how far out the credit risk curve do you want to move? Then, once you've made that decision, determine which fund you want, balancing costs, coverage, target market, premiums and discounts, and more. It's not an easy task, but given the need to squeeze out returns and yield in a low interest rate environment, it's worth putting in the effort to make that analysis. So in fact, now we want to bring in Gopi to discuss how he approaches the corporate bond space to sort of give an advisor's perspective on how to analyze the bond space and where to make allocations. Gopi, turning it over to you.
Thanks, Matt. Look, that was a good introduction to where I was heading. When we look at the corporate bond space, we're looking for can we diversify? We didn't want all our allocations to be in one bond. And can we get enough bonds, so that we can get them at a good price with lower transaction costs? And most importantly, we want to know what is the yield and also the total return that we can get from those bonds. And as we look at it, if I step back to 2008, when the markets were collapsing, everybody was running to the treasury bonds. And it was very easy to sell treasury bonds. And you could make a ton of money by selling treasury bonds. But nobody wanted to buy corporate bonds. But it was also a chance to buy them for a really good price and lock in those prices for a long time and get a really good yields. But as we move on further down and look at it last year, people started looking for yields because the pension funds and people's retirement needs were not being met by the low treasury bonds. So you had to go looking higher. And so people started bidding for the corporate bonds, and it reduced the credit spread. And so you couldn't even, you didn't even know what the price you were paying for it, because you would bid for a price. And just to clarify, in an equity market, you can go out, you can go to the stock market, and you can buy your ETFs or your, or your stocks at the price. But in a bond market, you have to go to the secondary market or to the primary dealer to get the bonds, and the price you quoted might not be the price where you get it, because somebody might come in and bid you down. And so it's a very illiquid and not a transparent market. So so trying to get the right price becomes really difficult. And once you don't know what price is, then you cannot evaluate what income you're going to get, so what your yields are, and then you don't know where it fits into your portfolio. So there's a lot of unknowns. And so those are the things we kind of really look at to figure out where we want to go. So as we moved towards bonds last year, we realized we couldn't buy any of the bonds at the right price and at the right yield. So we started looking at bond ETFs. And so looking at that, if you go to the next slide, what we said was, what do we want from these ETFs, and what do we want to get from it? So we looked at our cash flow. We looked at where we need our specific cash to be needed, both from your dividends plus also maturity. We looked at the total needs, and then we said, this is where we want to be, and this is what we want. And as we looked at it, when we had specific needs for a specific yields, we wanted to find the bond ETFs that fit those. And unfortunately, most of the bond ETFs have, I call it unending maturity, because they say you buy a 5-year maturity bond ETF. As you go further down, they don't become 4 years and 3 years. They are continuously 5 years. So as the bonds underlying that ETF are maturing, they're adding more bonds. And in a declining interest rate market, those bonds are going to yield lower. So your cash flows that you're going to get from those bond ETFs are going to be lower. And then the price, plus there's a price adjustment because of the lower yields. And so it becomes really difficult to both time both the yields, the cash flows, and also when you're going to get your principal back if you compare it to a bond, typical bond. So that was one of the things we looked at it. Then the next thing we looked at it is we wanted liquidity. So we wanted to make sure that we went and bought this bond ETFs, that there are enough assets under management so that that bond ETF won't disappear. You know, if there's not enough funds into that ETF, then most of them will shut it down, and then you have to take what the market offers. So we want to make sure it was a strong, healthy ETF. Once we've done that, then we actually looked at the ETF provider. Do they have the financial strength? You know, how do they do their business? You know, what is their history? What is their management? Are they conservative? Are they, you know, very loose with what they throw into their ETFs, in the ETF makeups? And then we looked at their strategy. This was most important to us. We said, what happens when those bonds are called? Because a lot of them have bonds which have usually 3 or 4 year or 5 year call period. And if that happens, what are they going to do with that principal? Are they going to just go look for the yield and put in a really feeble company bonds? Are they going to replace it with like for like? And so we wanted to look at all those things. So we looked into the structure of the ETF, you know, their description, their strategy, to make sure that they're following what is said. Then the last one is we tested it to different interest rate fluctuations. Right now, thanks to Bernanke, the interest rates are really low, but we know pretty soon, 2 years, 3 years down the road, inflation is going to take effect. And what will that do to your cash flows? What will that do to the price of the ETF? And so we looked at those things and said, are they really sensitive? And we stayed away from those which are really sensitive. And once we've done these things, then we said, okay, what is the price that we want to buy? If you look at a bond ETF and you compare it with an equity ETF, the bid-ask spread is really wide in a bond ETF, and because there's not enough liquidity on the surface. But then if you call the liquidity providers, you can get a better feel. So we looked at what price we want to buy, and then we called some of the liquidity providers to really see, can we really create these bond ETFs at a good price, and then what the yield would be. Once we've done those analysis, then we identify the ETFs, and then we look to see if there's an arbitrage, if there's a temporary lowering of that ETF price because of either a Greek default or some other thing, somebody's mispricing it, and that's when we try to buy those. Moving on to the next slide. When we did this analysis, what we found was, because the bonds were very difficult to get, because everybody was going after yield, we couldn't really time our cash flows to the bond ETFs within the parameters that we wanted. So we started more looking towards the, I call it with the fixed time frame, like the bullet shares and some of the other ones, where we knew what the underlying bonds were for the ETF, how much cash flows we're getting, and when they're going to mature. And so that's what we've kind of used those, but we've also used the other ones with no maturity, where we didn't need the cash right away. So
That's
those
great.
are things that we've used to identify the ETFs.
Yeah, and thanks so much, Gopi. I want to take a chance to bring in Jason here. I'll remind the audience, of course, that you can ask questions for myself, Gopi, Jason, Gene, using the Q&A tab on your screen. We've already gotten some great questions. Jason, just first, quickly, you know, I'll go straight to that product question, then we'll move more broadly into bond ETFs in general. But are the fact that bond ETFs don't mature really a problem? And what kind of advisor, you know, is that a problem for?
Well, it really depends, right, on what your needs and your focus and your outlook is. You know, bond ETFs that don't mature aren't necessarily a problem if the portfolio is defined enough to match up, you know, the way you want to implement your strategy. On the other hand, bond ETFs that don't mature can be a big problem in a rising rate environment. You know, as Gopi and as Gene mentioned earlier, from a mechanical perspective, they are constantly turning over the portfolio and selling bonds as they age and replacing them with longer duration bonds to maintain that duration target. So in a rising rate environment, you get a situation where bonds are falling in price and they're selling those bonds and locking in the losses and then extending their duration risk constantly. So that, much like the fear that is expressed with respect to mutual funds, the last person you want to be in a mutual fund in a rising rate environment is the last person to sell. It's not quite as bad of a deal in an ETF because you're not incurring necessarily the transaction costs on average that a mutual fund investor incurs, but you're still subject to this same you know, structural problem with respect to that perpetual duration target.
Yeah, I definitely hear that. I mean, how should, one question we got from the audience is, given that, why wouldn't investors just buy individual bonds?
Well, you know, they do. That used to be the primary, I think. If you had enough money to buy individual bonds in efficient chunks, then that was the sort of timeless strategy that financial advisors have used for generations. So a few years ago, one of our indexers, Accretive Asset Management, did a study, and I believe as of 08-09, individual investors in the U.S. held between investment-grade corporates and munis $2.3 trillion in their own accounts. But I believe on your website there was some pretty interesting analytics showing that in the last few years, the inventory of corporate bonds held by major banks and dealers has shrunken drastically. And so what you're finding is I go around and talk to advisors sort of traveling the country every week, is that it has become enormously difficult to source inventory in these bonds that they've been using for their whole careers. And so one advisor who switched from using individual bonds to using target maturity ETFs said, at the very least, you've saved me an hour a day, because I used to spend the first hour every morning looking for bonds for my clients, and it just became a burden that he just couldn't suffer anymore, and literally running his business. So I think that the problem in sourcing inventory and also the expensive markups that individuals typically suffer when they're buying individual bonds through a bond desk really, in this environment, take what is already a disappointing yield and knock it down even further. So that's the other benefit in general, is that with fixed income ETFs, you have access to institutional pricing. You combine that with a very low expense ratio on average, you can typically obtain better yields.
Let me broaden this out a little bit and bring in Gopi. You know, judging from the questions we're getting in, a lot of people were struck by the slide showing that nearly all corporate bond exposure right now is U.S. focused. That's true of bonds in general. Gopi, do you see or feel the need for international exposure in the bond space, or are you comfortable with U.S. only credits?
Now, we do look at international exposure because right now the U.S. corporate bonds are yielding such low levels But if you look at the balance sheets of a lot of the international companies, they're really strong. I would actually say they're much more stronger than the U.S. Companies. They have a lot more cash flow. If you look at the interest rate coverage, they're much more, I'd say, stronger. But because of this risk averance from U.S. investors, they typically, if you compare an apples to apples, they normally pay you higher dividends. And so we do have quite a good mixture of international exposure.
What about you, Jason?
Risk.
I mean, are you hearing much demand for international exposure in the bond space, and how should investors think about the risk they're taking on there?
We are getting quite a bit of interest in people that want to go international. I think it's partly they're driven there by the lack of yield in the U.S. and they have possibly an investment grade mandate, and they simply can't meet their clients' needs, so they have to go look for it somewhere else. Some people want the diversification, being exposed to a foreign currency, diversify away from high U.S. dollar concentration. On the other hand, that does add some complexity to the evaluation process, and that, you know, some of these foreign currencies can be quite volatile. And given how low yields are globally on a nominal basis, it doesn't take a big move in the currency to wipe out the yield on the bonds. So if it's part of a diversified, carefully constructed portfolio, that makes complete sense, but it's definitely a risk that investors need to be aware of.
But yeah, no, that's definitely true. And you're even seeing some ETF providers, you know, tackle the market with currency hedge products, right, to partially deal with that. Although there are pluses and minuses there. Yeah, we spent a bunch of time comparing treasury yields and corporate yields. One of the questions we got from the audience is, can one or either or of you, or perhaps both of you, comment on corporates versus munis and how that looks right now, and which is more attractive? Maybe Gopi first and then Jason.
Thanks, Matt. Matt, we look more at the corporate. One of the things I like corporate bonds is you know their fundamentals, you have the analysts following it, you have the financials, so you can really dig into it and see, you know, what they're doing. And if there's any news about that corporation, usually it comes out real quick, and then you can take action against those bonds. Whereas with the munis, it all depends on what the revenues they're getting in, and a lot of times that information is very difficult to get. Unless you're following the municipal bonds, the corporations on a daily basis, it's very difficult to really get that information. And even if you want to, you don't have it. And a lot of times you end up hearing it after it's too late. And by the time the damage is already done. And so we've been very, very skeptical in this environment, especially with the muni bonds, unless it's a revenue generating like roads or tolls or something that has, you know, like asset behind it, which is generating that revenue, which we can get a feel for it from non-government sources. Then we've gone into the muni bonds, but we've stuck primarily to the government bond, to the corporate bonds.
Right. What about you, Jason? I mean, Guggenheim's a huge fixed income firm. Any views on corporates versus munis?
Yes, Guggenheim continues to see great relative value in munis, but that is with the caveat that, and exactly as Gopi described, you really probably want to invest in munis through someone that has the capability to do the credit research on the individual issuers themselves. That you're literally digging into the politics sometimes in that within that, you know, governmental structure to determine the risk on some of these bonds. And so there's great value there. We certainly did not see the great wave of defaults in munis that was predicted for 2011, and that's created some value, that scare. But as Gopi mentioned, it takes some particular expertise, I think, to navigate that space to achieve the best risk-adjusted returns. And Guggenheim really does like munis. We don't like the longest duration munis, just from a risk-return perspective, we don't think that they're as attractive as more intermediate, say 10 to 15, 10 to 20-year munis. But apart from that, we think it's a good space to be allocating right now.
You bring up a great point about how hard it is to research munis. One of the things Gene and I have found, and the other folks here at IndexUniverse, is it's hard to research credit and bonds in general. I mean, you go to different issuer websites and they calculate duration differently. It's hard to get pricing. For advisors out there, maybe we'll start with Jason and then go to Gopi. How do you approach, getting good data to make the kind of comparative analysis that you need to make in the bond space? What do you suggest, Jason?
Well, that's a great point. I mean, there's no easy solution. When it comes to evaluating individual credits, very few people have the resource. I mean, Guggenheim monitors 1,000 issuers in real time, and that's not the entire corporate space. But they have 90 credit research analysts and a dozen attorneys, right? So I think that job is best left to institutions with the resources to be able to do that. Now, if you go into a product like an ETF, you're in a great way relieving that burden by the huge diversification you're achieving. So at that point, you're letting diversification manage to a great extent the individual concentration risk. And now what you want to do is go back to the point that you discussed earlier and look at, are they doing anything funky with their credit quality allocations? Is it a nice bell curve, or are they barbelling it, as you mentioned? And that is something that you can probably come across by digging enough. Even calling the issuer to get some information.
Right. I mean, Gopi, what do you think about that? And how, as a related, more general question, do you decide how to balance taking on interest rate risk versus credit risk, and just review sort of your decision making there?
Sure. And what we look at is we kind of start with the credit ratings that the different companies give, but then we dig deep, and the primary thing for me that drives is, how is their cash flow? Is it increasing, decreasing? Is it from creative financing, by like creating special items, or is it from the bottom line, from sales growth? And then the next thing we look at is what is their interest rate coverage? Is it the same fundamentally? Is it decreasing while sales are going down? We kind of look at all those things and make sure that they're really meeting those needs. And the other things we do also look at is sometimes they'll underfund or overfund their pension programs or some related things. And those kind of things throw a red flag when we see that they're not funding properly, or in a low interest rate environment, if they're not funding their, I call it the corporate programs properly, then that's going to put a drain on the cash flow later on. And so we look at those kind of things which are more of a qualitative based to see how strong that company is. And we really don't let the rating agency drive the decision.
Good thoughts. We have a few more minutes. Jason, I want to run through a few quick questions. Certainly a few years ago there were huge concerns about premiums and discounts in corporate bond ETFs. I know some advisors swore off bond ETFs forever. Do you think anything's changed there? Do you still hear those concerns? And how should people think about that topic?
I hear that a lot less, and it's certainly getting a lot less attention in the financial press than it did a few years ago. When we set out to develop several of the fixed income ETFs we've launched in the past 2 years, the very first question we addressed is we need to make sure these trade well. And so as you described earlier in your presentation, the use of optimized baskets and the offering of the option to create with cash has really done a lot, I think, to improve the trading efficiency or eliminate the premium discount issue. It's still there at times, but I think that it also gets back to which price is the better measure of fair value. In high yield, if a high yield ETF is trading at 1 or 2% below NAV, but the bid-ask spread on the underlying bonds as liquidity dries up is 4%, you could still be trading inside the spread of the underlying, and that might be actually fantastic liquidity. And that's what actually you hear from a lot of advisors is that, it may be trading at a 2% discount to NAV, but when I hit the button and want to get out, I'm out. And I'm not looking for a market on an off-the-run bond where they're pricing me 5 or 10 points wide. They're still only pricing me 25 basis points wide between the bid and the ask and the ETF. 1/10 the spread in the underlying bonds. I think that apples-to-apples comparison really puts the current state of the ETF product in a favorable light.
One more question, and this is from the audience, drives back to the target date bond fund. So want to cover that. Can you review the reasonableness of an expectation of holding a target date ETF bond share to maturity and getting back par at the target date? Is that how investors should think about those? How should they think about those ETFs as they mature?
Well, the thing to remember is to kind of think of the underlying portfolio and think of what you're really holding there. We don't like to use the word par. While any bond that does mature without defaulting does mature at par, the ETF is holding a whole portfolio of bonds, and they mature at different points in time. So what you really have to look at is weighted averages that can't be tied to one specific date, while the investments all mature within a certain year. In the final year as bonds are maturing and then reinvested or converted to cash in anticipation of the fund's maturity date, there's a little bit of, of wiggle room or uncertainty as to what the yield is going to be in the very last few months of the product's life, because you just don't know what short-term reinvestment rates are going to be. They could be higher, they could be lower than the original yield you purchased when you bought the fund. But you need to make the point that the stated yields on these funds are expected total returns. So occasionally the share creation process forces existing investors to reinvest what would have otherwise been distributed as monthly income, and that reinvestment shows up in a higher NAV going forward. Conversely, if rates were to rise or shares would be redeemed at a certain time, an investor could get a larger distribution than they anticipated, but fair is fair. Now NAV makes a compensating move. So as we've seen the life cycle already complete itself in our first target maturity ETF, that process really did function exactly as intended. So it's important for investors to know that you do get monthly net income distributions, but there is some variability, and regardless of what the underlying bond prices are, everything is sort of netted internally. So we, for example, saw our 2011 corporate mature at a value that was higher than its initial offering price, even though we owned premium bonds for the entire lifespan of the fund, right? So you would think I own premium bonds, I'm going to get less back than I put in, but through the netting process, they actually got a higher NAV value than the initial launch price. So that's all to say that it is a total return strategy, but it is bond math and fund accounting. There's really nothing fancy going on. It's the result of having investors co-mingled in the product.
Makes a lot of sense. Unfortunately, with that, we're out of time. I'd like to thank my panelists, Jason Bloom of Guggenheim and Gopi of Orion Financial Group, as well as Gene Koisman here at IndexUniverse. For more information, you can check out our website, Guggenheim's website. Thank you very much for attending this webinar. We hope to see you again at a future IndexUniverse webinar series event. Thank you very much and have a great afternoon.